Welcome back to Talk Property to Me. My name is Brad East.
I'm Aaron Downie, and today we're talking about how the RBA rate cuts impact your borrowing capacity and repayments.
So what we're going to be breaking down is exactly how much your borrowing capacity increases with these rate reductions, which is something that I've heard a lot of people say over the last few years is I'm going to wait for rates to go down. All these conditions are going to get better before I buy something. We're really going to break that down today and see how much you've actually been losing by waiting so long.
Yeah, it's opportunity cost. We talk about it all the time, but for context today, we're just going to do a really simple case study with a couple with no kids earning $80K each.
Yep, so very standard sort of scenario here. So what we're also going to look at is that price growth versus the borrowing capacity, just to see sort of what that difference is. And we're also going to look at what the effects of the interest rates cuts have done to repayments as well. And then I'll let you know at the end of the episode what a good interest rate is at the moment. And if you're not on that interest rate, what steps you can do to get on a better interest rate.
Yeah, because it is the difference in, two rate cuts is a couple of $100 per month. So
definitely worth it.
It's worth, and revisiting.
And there is a way to sort of fast track those savings as well, which I'm going to talk about at the end. So we'll get straight into it. As Aaron said, we've got a couple with no kids earning $80K each. So for the purposes of this case study, I have used the same lender just to keep it nice and uniform.
Yeah.
It is a Big Four lender. I won't tell you which one. It is blue.
And it's the opposite of East.
Yeah. So basically at 6.18, which the rate was 6.18 literally a few days ago before the first rate reduction, their borrowing capacity was 782,000. We'll just round it off. So 782,000. Rates actually have reduced now by 0.25. So that took it down to 5.93. Mm-hmm. Their borrowing capacity went up 17,000 to 799,000.
Which is a 2% increase.
Correct. So it's not bad, but it's also, if this is something you've been waiting for the last 12 months, congratulations on increasing your borrowing capacity by $17,000.
Yeah. And the thing is, to put that into context, for most people listening, they're sort of Sydney, Newcastle based. For a $900,000 property based in Newcastle, which is a pretty typical purchase, Newcastle increased by 5% this year.
Yeah.
So you've just increased your capacity by 2%, but the market's moved by 5%. And that's 5% of 900,000, not
correct.
The $800,000 borrowing capacity.
So based on that bit of a pattern there, so we're assuming that we're going to get another rate reduction this year. I think all the Big Fours have agreed on that there should be another rate reduction this year, which will take, in this scenario, the interest rate down to 5.68. Mm-hmm. So the borrowing capacity has increased a further $20,000. So the borrowing capacity is now $820,000. So in total, those two rate reductions have equaled we'll just call it $37,000.
Yeah.
Those two rate reductions, so 0.5% has equaled $37,000.
And again, to put that into context, that's only if you're on a decent rate.
To start
and then
with.
The banks have adopted those rate reductions.
Yeah.
If you're on, so that's 6.18%. I can guarantee there's some listeners on here at 6.8 or 6.9%.
I can guarantee you. So I actually did some research into it, and over 41% of homeowners in Australia don't even know what their interest rate is.
Yeah, there you go.
I will challenge the 41% people to log into your internet banking. Do some homework after this episode or during it. Pause it, whatever. Check your interest rate.
Yeah.
If it doesn't start with a 5, it's too high. Yeah. I'm going to talk about that a little bit at the end as well, but that's the challenge.
There you go.
I couldn't believe that. 41% of people do not know what their interest rate is.
Yeah. And we're talking about a 0.5% difference increasing a borrowing capacity by $37,000 based on an $800,000 purchase. Imagine if you had, a 1%. If you were up around the 7% and you drop your rate down to 6%, you're probably talking about $100,000.
Yeah, I think what a lot of the issues come with, where people are saying I'm going to wait for rates to come down from a borrowing capacities to increase. I think a lot of that came from when rates were at 2%.
Yeah.
Your borrowing capacity at 2% was ridiculous.
Yeah.
At the 30-year average of around 5% interest rates, that's probably where we're going to end up.
Yeah.
We're not going back down to 2%.
No.
So we're going from 6.5% down to 5%. That increase isn't a substantial amount. Well, it's not worth enough to wait for.
Yeah.
Because what's happening as well at the same time is property values are going up around that 7 to 10% per annum. In this scenario, we've used a $900,000 property. So if we were waiting, let's just say this couple are going, nah, stuff that. We're going to wait until the end of the year until we get that next rate reduction. We actually want to buy when rates are 5.68.
Yeah.
In that 8 months at 7% growth, there's a $41,000 increase to that property.
Yeah.
So you've waited 8 months to gain $37,000 worth of borrowing capacity.
Well,
but that property,
it's not, because you've already gained
I've already got
17,000.
one. Yeah,
So you've
waited
waited
8 months for 20 grand, sorry.
Yeah.
But the property price has gone up 41,000.
Yeah.
So it's actually cost you money to wait.
And that's only on a 7%
That's
growth
conservative.
rate. That's a conservative figure
Yeah.
for most states. I know a lot of investors, and I don't recommend buying in Townsville, but a lot of investors are. Townsville, they're forecasting Townsville to do 30% this year.
Yeah.
So you're talking about $700,000 by 30%, and you're sitting here waiting for an extra 3% decrease in rates.
Yeah. So I guess the basics of what we're trying to get across here is, if you're waiting for interest rates to come down to increase your borrowing capacities to purchase for more, that property that you wanted has now gone beyond reach because you waited.
Yeah. Now you're looking at a different market or a different property type.
You're looking at a property now that's 5 Ks further out of the city or whatever it is. So 100%, this is the market we are in now. Always try and, when you are purchasing a property, my advice is to always adapt to what the market is at that time.
Yeah.
If your borrowing capacity is $600,000 to $1,000, buy at $600,000. Get into the market now.
Yeah.
Don't wait for all these unicorn situations to pop up where you might be able to buy at $750.
Yeah.
Because you buy this $600,000 property, at the end of the year it's worth sort of $650. And then you compound on that $650 times 10% again.
Yeah.
705.
Yeah.
It's just going to keep
100%.
going up and up and up. And I guess why I'm getting angry at that is because I've seen so many people get pre-approvals at the lower amount and they don't do anything with it.
Yeah.
Actually, the actual stat with the big 4 banks is 60% of pre-approvals do not proceed.
Oh, yeah.
Let that sink in. So 60% of people get a pre-approval, ready to purchase, and they go, I can't find anything.
Yeah.
So that's another challenge for people. Use your finance when you've got it.
Yeah.
Buy something that's within your reach at that time. Don't wait for all these things to happen.
I think for property investors and people already in the market, they probably understand the compounding effect of property, or the compounding effect in general. But for anyone who doesn't understand that compounding, that's a great thing to become familiar with, because that's why you invest in property.
And it really kicks in around that 10-year mark.
Yeah.
If you're buying and flipping, within a few years period, you actually get the most benefit of after about 10 years.
Yeah, buy and hold.
And that's generally when your property will become positively cash flowed.
Yeah.
That first 5-10 years, there is going to be a small out of pocket.
Yeah.
Because the value and the rental yields versus your debt don't quite match up yet.
Yeah.
As that value goes up, and let's assume you're on an interest-only loan, the loan amount stays the same. Value goes up, rental yield goes up.
Yeah.
So,
and that's why I recommend you're not buying in Townsville. You're not buying property for the next 5 years.
Yeah.
You're buying property for long-term investment to set yourself up for the future.
And just sit on it.
Just sit on it.
Yeah. Another thing that I guess I always stress to people is, this isn't a comparing sizes sort of exercise. I hate seeing all these people online that I've got 80 properties or I've got 420 units. Who gives a shit, for one? Not everyone can do that.
Not everyone wants to
do that. We're talking to, majority of what we're helping people with is mum and dad or young people that just want to get a couple of properties to set themselves up for retirement.
And I'm in property. I buy property every day for people. I don't want to personally manage 30 properties.
No.
It's not a goal of mine.
No.
I would prefer to invest in Bitcoin because it's still a good thing to invest in, and it's less admin for me.
This is not personalised financial advice. Talk to your financial planner.
But for people, like I said, some people, like you just said, Brad, some people just want 1 or 2 properties to look after themselves at retirement.
Don't invest for your ego. That's all I'm saying. So what we're going to look at now is what effect these rate reductions have had on repayments. So from going from 6.5 to 6.25, we'll run through that over a couple of different loan sizes. Mm-hmm. So for $1 million loan, it saves around $163 per month.
That's just a 0.25% reduction, which we've had.
Yep. So we're going to assume you're on 6.5 and you've gone down to 6.25. $1 million loan, 163, 750 loan, 122, 500 is 81, and a 250 loan, 250K loan is $40 a month.
Yeah.
So definitely worth, it was worth a bit to people. Now going from
I think 6.25 to 6%, it's a very similar amount.
Very, very similar. Savings are, it's always going to be very similar at that amount. When the interest rates are getting lower, it's a little bit less. But going from 6.5 to 6% at $1 million loan, that's actually $325. At 750, 243. At 500K, it's 162, and at 250, it's 81. Now, the reason that I'm stressing that 0.5% drop is because that's what we are seeing average refinance savings as being, around 0.5%. Yeah. So to put it in perspective, the average loan we're seeing at the moment with a Big Four bank is around 6.8. Yeah. So we dropped that 6.8 down even with the 0.25. You're still 0.5% higher than what everyone else that's coming new to that bank will be on. Yeah. So what I see a lot of is, I said it earlier in the podcast, 41% of people don't know what their interest rate is. Yeah. And that's how the banks are posting these $5 billion half-yearly net profit margins. It's because 41% of people don't know what rate they're on.
And that's a 0.5% reduction, like we were talking about before, for the 41% of people who don't know what their rate is. If you drop your rate by 1%, you're talking about $650 per month.
Yep. It's a lot. So if you think it's worth saving, $325 a month if you had $1 million loan, log into your internet banking today, figure out actually how much you're paying. If it doesn't start with a 5, reach out. I'm happy to do these things. This is what we do on a daily basis. Yeah. We look at your current interest rate, what you could be getting and what those savings are.
And it's not like you're applying for a new loan or a pre-approval. If you're with a bank, like I'm with the Commonwealth Bank, and I just called them and asked for a rate reduction.
Yep. Tell them another good tip as well is actually call them and ask for a discharge authority. Yeah. So a discharge authority is the last step before you actually leave that bank. Yeah. So what it does a lot of the time is it triggers their retention sales team, and they'll call you and they'll try and keep you.
What rate does it have to be to keep you on board?
Well, in my opinion, they need to offer you something below 6%. Yeah. Currently, right now, all the Big Fours are below 6. Yeah. At their carded new to bank rate. And that's the key as well, is it's new to bank. Yeah. So they're rewarding new people coming in and signing up with them. You guys that have been there for 20 years and been loyal because you signed up with Kathy down the branch or whatever 20 years ago, I don't give a shit about you because you don't know what your rate is and you don't give a shit. Yeah. It's the new guys we're trying to get in. Yeah. So don't be loyal. They're not loyal to you. Yeah. It's as simple as that. Works me up this shit.
And obviously, this is all just general. All of the repayments are going to differ between different banks or different lenders, and obviously the difference in loan to value ratios in different situations. So this is just general figures.
Yeah. So just as I said, have a look at what you're currently on and be aware of it. You don't just set and forget these things. And to quickly explain how banks get away with doing that. So they have what's called a standard variable rate. Yeah. So let's just, for the purpose of this, let's just say the standard variable rate is 8%. Yeah. So what they do then is they give Aaron a 2% discount, and his rate is now on 6%. And now they've given me 2.5% discount for whatever reason. I'm on 5.5%. Yeah. So what they slowly do over a period, that discount reduces. Mm-hmm. So they actually haven't changed the interest rate. They've just changed your discount. Yeah. So they get away with doing it that way.
Yeah.
So, oh no, we didn't raise your interest rate. We reduced your discount.
Yeah.
So
Yeah.
they're sneaky in how they do that.
Yeah.
I know that with Commonwealth Bank and some of the other big fours, there's actually algorithms built into it. So if all your internet banking is through them, they will see how much income is coming into your accounts.
Oh, yeah.
They see basically your cash flow, and what their AI or what their algorithms do in the background is calculate the likelihood of you being able to refinance elsewhere, and then it matches that up again. So they've got data on CoreLogic and other systems.
Yeah.
It also then gives them an estimate of your loan to value ratio.
Yeah.
So if your loan to value ratio is above 80%, they start thinking, oh, well, it's unlikely they're going to refinance.
Yeah.
Let's reduce the discount.
Yeah.
All these different things they've got in there, and I'm happy to be corrected by one of these banks that does this if I'm incorrect, but that is what I see happening.
Yeah.
If low income earners or people that, they use the term mortgage prison, people that are trapped into these rates, they're less likely to get a better rate than someone that's earning a huge amount, and the bank sees them as more likely to be able to refinance.
They're going to come back and re-borrow more money.
Correct.
Borrow another, draw out the equity, buy another investment, go again.
They also do it in postcodes as well. So
100%.
if they've got too many loans or too many houses within a certain postcode, they don't like that.
Yeah.
They will deliberately decrease margin or decrease discounts in those areas so people discharge and refinance, and they get to then sell those funds to someone else in a different postcode.
Yeah.
So we see that a lot as well.
Yeah.
So don't be loyal to your banks. They're not loyal to you. Reach out if you need a free, so that's probably a good key. Mortgage brokers, majority, don't charge you a fee at all.
Yeah.
We get paid by the lender that you choose to go with.
But there is, like, with the 41% of the people who don't go ahead with their purchase after pre-approval,
60% for that.
60%.
Yep.
There are mortgage brokers out there who just don't do pre-approvals anymore.
Yes.
And just say,
Heaps.
yep, you'll be able to borrow money, and then just do the loan really quickly when they go and find something.
The record I had, so a pre-approval lasts for 3 months. The record I had for reapplications was 9.
Yeah.
This guy just wouldn't let it lapse.
Sorry, mate, I can't do your pre-approval.
On the 9th one, I said, mate, I think you should go find a property now.
Yeah.
Like, that's just getting a bit ridiculous.
Yeah.
He did find something, believe it or not, and he did purchase. I'm not saying his name on here, but well done. But that's it for today. Nice, short, punchy one.
Yeah.
Ran through what the borrowing capacity looks like versus the market growth. We've talked about what rates should be and what to do if you don't have an interest rate starting with a 5. So get into it. Feel free to reach out to either of us on the socials. Talk property to me.
Just drop us a DM on the
we
Instagram.
reply to the Instagram messages that we receive. We get quite a lot, and I take the time to go through them all and reply to them all. So jump on and send us a message.
Yeah. See you on the next one.
Thank you.